All right, to make sense of broader markets and, of course, market setup and how it's going to turn out in the next couple of days, we're now joined by Bala, who's a chief market technician at cashthechaos.com. Thank you very much, Mr. Bala, for joining us on the phone line. Help us understand, how do you really see moves in the market, both domestically and on Wall Street, on the back of this latest development that's coming from China, where it has announced to slap 84%, tariffs up to 84% on US imports into China?
Yeah, given that background, let's first take the global markets first. The US markets has been exhibiting an oversold reading for the last 3-4 sessions, and the market hasn't responded to such oversold readings with a bounce, and the bounce that came yesterday got sold into it, and it closed in the red, barring the Nasdaq. So a market that's oversold and doesn't respond to an oversold condition with a bounce is a very dangerous market. And if you look at the European markets' high-yield credit spreads and the US markets' high-yield credit spreads, they have shot up and widened a lot, and that's not a good sign. And if you look at the volatility index for the bond markets, that's also is rising vertically. So this is not a good sign for equity markets. This can push a few red lines if this condition were to sustain for the next few days. When it comes to the local Indian markets, I've been bearish on it since the 1st of October. And in fact, I think it was first to ET Now I spoke when the China stimulus was announced. I said the markets are heading towards the June 4th range, the post-election lows, and the markets are there. And in the very short term, I believe there is one more lower low due for the Nifty index below the low that we saw on Monday. If that low can hold about 21,608, there is hope for bulls. But if 21,608 doesn't hold, then we have to consider alternate bearish options. So we'll watch what the next new low, which is likely to do. And if it were to hold about 21,608, I think there are some bullish possibilities. But at the moment, we need to wait and watch, hold cash, do nothing.
All right, so hold cash and do nothing in that 600 mark, 22,600 mark is something that you are stating that we will be doing well if we manage to hold on to that mark. In fact, ladies and gentlemen, let me also take you through the markets and how they're shaping up. Well, we've seen correction on Dow Jones, as you can see on the screens as well. This is an impact of the tariffs announcement that is coming from China. The Dow Jones is down by close to 300 points. The Nasdaq is up by close to 50 points. In fact, that's the only index that's currently in the green. The S&P 500 is down by close to 20 points. So the fall is not as much as what we saw earlier this week on Wall Street, but still a correction being seen. The Nasdaq Biotech Index is falling 2.6% to its lowest since October 2023. Meanwhile, the Nasdaq, like I said, that particular index is not showing correction. In fact, it is still in the green. It's up by 30 points. Apple is up by 1.4%. The S&P 500 down 0.4%. In fact, the Nasdaq Biotech Index has fallen 2.6% to its lowest since October 2023. So let me come back to you, Bala, since we were discussing about the markets, global and Indian markets. You mentioned that there's going to be a fair bit of volatility and one major correction is to be seen in the coming few days. But do you see any possibility of a positive correction, perhaps a rise in the markets, given that Donald Trump has stated that at least 70 countries are looking for engaging with the United States. They're looking to engage with the United States to arrive at a bilateral trade agreement or some sort of deals that they're ready to offer. And we've heard that from Israel as well, from Japan and Korea. So do you anticipate some sort of an upward move in the coming few days?
If it were to come through, to me, as market stands today, it will probably be a flash in the pan, or what we call as a dead cat bounce. So if something meaningful has to occur, a lot of damage needs to be repaired for the global markets as well as for the local markets. And at the moment, it doesn't seem likely. the likelihood of the trend that started for the U.S. markets from late December or February, depending on index you're looking at, and for the Indian markets that started from the end of September, that is the dominating trend. So at the moment, to reverse the trend, the markets need to do a lot of damage reparation, and the chances of that currently aren't too bright. But let's wait. As I said, I will watch the bull bear divide for me is around 21,608. If 21,608 were to break even on an intraday basis, I think we need to be even more cautious, and we need to pay more attention to the bond markets. This kind of volatility that we are seeing in the European and US bond markets is sort of unprecedented in the short term. The spreads rising vertically and the widening spreads are not good signs for bond funds. And this kind of volatility can push the red lines for some funds and can knock things where things shouldn't go. So we'll wait and watch. So there is no hurry. The markets are abundant. There's always opportunity. Even if the market were to bottoming is not an event. Bottoming is a process. Markets tend to register a low, go back up, and then try to retest and put on a base. So once the basing process is done, there'll be sufficient opportunity to people to get bullish. There's no need to be right at the low and at the exact turn. We can pay a premium for safety. So wait and watch.
Right, so wait and watch, but to retail investors, what would you suggest? Because this volatility has been unprecedented, like you were stating. It's been a rather volatile, what we've seen over this past a month. And now, of course, Jamie Dimon is also suggesting, he has said reportedly that recession is a likely outcome from Trump's tariff, and that has added to rising fears of an economic contraction in the West, especially as far as the markets are concerned. But, what would you advise investors to, so far as their strategy is concerned? What do these moves really signal?
From my limited understanding of economics and looking at cross assets, my reading is that this is starting to look like a deflationary scenario rather than a stagflationary scenario. So, and if that were to be the case, what we'll do under a deflationary scenario environment, it'll be cash and cash equivalents. So so if you keep your money in short-term government bonds and fixed deposits, short-term money markets and things like that, where there will be safety of capital, and as well as there will be a little bit of results, and return of capital. But that's what the market is giving. You have to take what the market is giving. You can't put your capital at risk by being in the equity markets or the bond markets. So that's the place to hide at the moment. So a lot of times people get misled by the fact that if you miss out the 10 best days, you will lose so much. But what people don't talk about often is that if you avoid the 10 worst days of the markets, your results go up exponentially. So that's never spoken about by people saying that you can't time the markets. If we can't time the markets, I won't be talking to so many media channels for the last 10 years.
Right, Jay, but what do you anticipate, given that the United States is bracing itself for a softness according to what commentary is coming in from different quarters as far as that is concerned? Then you also have the challenge of tariffs, like I said, which is going to drive up prices. So what are you anticipating and expecting from what Fed's decision, the next decision of Fed will be?
I wouldn't be surprised if there were to be a hike. But it may not be on the card, because I know if you gather from what Ray Dalio is saying, the country which is imposing the tariff, it's inflationary for them, whereas for the countries which are recipients of the tariff, it's deflationary for them. So that being the case, I would go with what Ray Dalio is saying. If it's going to be inflationary for the U.S., I don't think the U.S. the Fed is likely to cut. So that's beyond my pay grade. It's my interpretation of what Ray Dalio has said. So I would anticipate nothing from the Fed. Hold might be the case for me.
All right, so hold might be the case is what you're suggesting. Meanwhile, volatility really sort of persisting back. But now, as we speak, Jay, the markets are suddenly in the green. We're seeing the Dow Jones up by almost 30 points. In fact, the Nasdaq has jumped up to close to 150 points. In fact, the S&P 500 also in the green, and of course, gold has inched upwards as well. So let's get into your comments on where do you see gold's trajectory going? Because earlier this week we were seeing that gold was taking downward moves.
Yeah. See, gold. The problem with gold is, Mark. Let me put it this way: whoever I speak to, their brother-in-law, their sister-in-law, and their dog is bullish on gold. So gold that is developing into a sort of an excess sentiment out there on one side. Right now, it's bullish. And if gold were to go below 2,900 on a closing basis, I think it would have registered a very significant top. But as long as 2,900 is protected on a daily closing level, I think gold is okay. But the bigger point is, it is at the possibly at the late stages of a move. So you don't want to get too invested. If you have been holding gold for the last several months, then that's good. You might want to keep a trailing stop at about 2,900. And if you see silver is not even hitting 52-week highs, leave alone all-time highs. So you might want to avoid silver, but keep a trailing stop on gold at 2,900.
So, in fact, we're getting some news, fresh updates as far as Europe is concerned. So, let's address that as well. The European Union has hit back as Donald Trump continues to wage the tariff war. European Union has approved tariffs to hit around $23.2 billion worth of U.S. goods in retaliation for the 25% of duties on the bloc's steel and aluminum imports. EU move marks a significant escalation in the transatlantic trade dispute as well. And this is likely to send ripple effects across global markets. And, it is expected to put trade pressures on negotiations and potentially impacting sectors on both the sides of the Atlantic. So let's take that one final question from you on these negotiations that Donald Trump claims that many countries have been having with him. But on the other hand, we're seeing retaliation coming in from China, retaliation coming in from European Union as well. As an investor, somebody who's closely watching all of these moves, how soon are you expecting, countries to sort of sit on that negotiating table and a middle path? Do you see a middle path which can be found as far as the Trump situation and tariff situation is concerned?
See, the best case scenario is, there is 10% tariff across the board for every country. He says Trump has said he's not going back on that. That being the case, even that itself is going to bring a global slowdown. So in that environment, there's a lot of moving parts, and I'm sure he's not going to, go back on China and reduce the tariff less than 50%. That'll be egg on his face and a loss of face for him. So there is even if there is no tariff on India, and India has got a much lower tariff, a global slowdown could impact India, and there will be places where China could dump its goods, and that is
right. Right. Jay, thank you very much. I'm afraid we have to cut that conversation short, but thank you very much for joining. Of course, as far as dumping is concerned, well, the Indian government has stated that it will take all possible measures to arrest that trend if that happens, if there is dumping into India from other countries in Southeast Asia. Ladies and gentlemen, let's...
If you like this video, then like, share and subscribe to ET Now.